Do you ever wonder how big investors like Warren Buffett and Cathie decide which stocks to buy and when is the right time to sell? Studying whether a stock has good value is called fundamental analysis. And yes, you can do it too. So in this video, I'm going to explain what fundamental analysis is all about and how you can use it when you're building up your own stock portfolio. And I'm going to keep it super simple for total beginners. Before I go on, this video is possible thanks to our delightful sponsor, Cathie. Cathie is an award-winning global Forex and CFD broker. If you're keen on trading share CFDs and some of the world's most popular stocks with zero commission, check out the platform for yourself. I've left a link in the description below. I also need to say that this is not financial advice. I'm just relaying the data. Always do your own research. So first, the basics. Fundamental analysis is essentially where you try to gauge the real value of a company's share price. You do this by looking at financial and economic information about the business. This includes how much the company is earning and losing, future growth prospects, and how popular the brand is. It's based on the assumption that a company's share price will reflect its true value over time, and so it makes sense for an investor to identify whether the stock is currently trading above or below that true value. That is, whether the stock is overpriced or available at an attractive price. Fundamental analysis is generally used to find long-term investment opportunities and so doesn't focus on short-term price fluctuations. That's where it differs a lot from technical analysis. And if you want to check out how that works, I've left a link in the description below. That being said, many top investors consider fundamental analysis to be the most important step in the stock selection process. The process can basically be broken down into two parts: quantitative and qualitative. Okay, so number one, look at the numbers. First, the quantitative. This is all the numerical information like the company's revenue, earnings, assets, and liabilities or cash flow. These can normally be found in a company's financial statements. These numbers are then used to produce financial formulas that are really useful for comparing the company to other similar companies in the same industry, the overall market, or even past data. Probably the most commonly used ratio is what's called the price to earnings ratio. It's calculated by dividing a company's share price by its annual earnings per share. So for example, if a stock trades for $15 and the company's earnings are $1 per share over the past year, its P ratio is 15, or 15 times earnings. So typically the lower the number, the better the value. Although it can be tricky, since a high number can also indicate investors are confident about the future of the company. Debt to earnings ratio is another common formula. It's a good way to gauge the financial health of the company by looking at its level of borrowings. A high debt to earnings ratio could be a sign it's a higher risk investment, while a lower ratio shows the company has room to borrow, especially during tough conditions such as a recession. The debt to earnings ratio is calculated by dividing a company's total debts by its EBITDA. So EBITDA being earnings before interest, taxes, depreciation, and amortization. So other common quantitative formulas include earnings per share, where net income is divided by the number of listed shares. Then there's return on equity and the dividend yield, which shows how much a company pays out in dividends each year as a percentage of its share price. While the numbers are important, you also need to consider the more subjective, qualitative factors related to the company's business. In fact, Warren Buffett himself has said it is far more important to invest in a good business than a cheap stock. And there are a whole bunch of qualitative factors that can be used to measure a company's worth, but here are some of the most commonly used in stock analysis. Okay, so first, competitive advantage. Long-term investors want to know if a company will be able to sustain and grow its market share over time. This advantage can take the form of a trusted brand name, which gives a company pricing power, like say Apple. It could be patents that protect it from competition, or it could be scale that gives it a cost advantage over rivals. Mining companies are a good example of this, where the huge costs of starting up operations keep most players out of the market. Next is the quality of management. One of the biggest factors that affects a company's prospects is the team at the top. Does management have a successful track record? Are there females and males in the C-suite? And is it diversified? And how does the CEO come across to shareholders and the public? Could these things impact the stock price, for instance? Then there are industry or economic trends. Veteran investors generally focus on industries that show prospects for long-term growth. For instance, e-commerce sales have surged over the past 2 years. And another example is the electric car industry, whose growth prospects have surged as dozens of countries set deadlines to end the manufacturing of petrol and diesel-fueled cars within the next few years. There's no single best approach to stock analysis. Fundamental analysis can be done using either a top-down or a bottom-up approach. The top-down approach starts at the macro level and works its way down to the company level. In this case, a trader will start by looking at the broader economy or industry trends to then help identify a particular stock. For example, electric vehicles is a clearly growing trend. Which stocks are best placed to take advantage of that trend? Or even tracking trends on social media to see which stocks are becoming popular. The other method is the bottom-up approach, which is where you start by analysing an individual company and its overall value as a starting point. It works on the assumption that a good business will be able to outperform even during unfavourable economic or industry trends. Keep in mind that while fundamental analysis can give you some great insights about the company, there are no absolutes in investing. In fact, sometimes the market might choose to ignore some fundamental factors over others. GameStop is the most obvious example, where traders ignored the firm's arguably poor financial position in favour of chasing the trend. Or Tesla, whose PE ratio is over 100 times the rest of the car industry, despite making less cars or profit. That's not stopping investors from buying. But when you take all of those fundamentals into account, it can paint an interesting picture about the future of the company. Just don't be surprised if the rest of the market doesn't agree with you. Okay, that's it from me today. Don't forget to hit the like and subscribe button. If you're interested in checking out the Cathie platform, I've left a link in the description below. Thanks so much, guys.